Hi everyone, this is our second video covering retirement accounts, and we'll be going over one of my favorite accounts, the Roth IRA. If you want to learn more about building wealth, then please subscribe to our channel. Make sure to check the description for this video because we may include supplemental information there. Before we get into it, the content contained in this channel is not intended to be financial advice. I am not a certified financial planner. The content is meant to be educational, is based on my personal research into the subjects presented, and contains my personal opinions as they apply to certain situations. Your situation may differ, and please do your own due diligence. As usual, our videos will be following a format where we provide the main objective, go through some details, provide some hypothetical situations to illustrate the concepts, and wrap up with some final thoughts. Our main objective in a Roth IRA is to have a tax-free source of income in retirement. So what is a Roth IRA? A Roth IRA is a personal retirement account, so it isn't sponsored by an employer like, say, a 401k. It is funded by post-tax dollars, meaning you will not be able to make any deductions in your tax filing of the dollars that you fund your Roth IRA with. The earnings grow tax-free, so there are no taxes associated with realized gains. For example, if you sell a stock at a profit, you won't be paying taxes on those profits, but you are also not able to claim any unrealized losses. Qualified withdrawals are tax-free, similar to a Roth 401k. So what we are trying to do here is pay a smaller amount of taxes up front so that we will not need to pay taxes when the time comes to make withdrawals from the account. Like with other retirement accounts, the Roth IRA does have restrictions. First, we'll go over the restrictions on the contributions. There are limits to the annual contributions you are allowed to make, and in 2024, the contribution limit is $7,000 with a catch-up contribution that results in a total of $8,000 if you're aged 50 or over. The contributions are also capped at your total household income. So, for example, if you're a teenager in high school with a part-time job making $3,000 a year, then that would be your limit. Also, these $7,000 and $8,000 limits are individual limits, so if you're married, you would each be able to contribute. The contributions do phase out depending on your modified adjusted gross income for the year, which is depicted in this table for 2024. I won't go through all the details, and please be aware that your income and filing status may affect your contribution limits. For example, if you're single and have a modified and adjusted gross income of $150,000, you would not be able to contribute $7,000 for that year. The amount you are able to contribute would be prorated using a formula provided by the IRS. There is a way around this called a backdoor Roth IRA, and we'll get into that in a future video. There are also restrictions to withdrawals from a Roth IRA. In general, qualified withdrawals are made after you are at least 59 and a half years of age and the account is at least 5 years old. So if you are interested in utilizing a Roth IRA, you'd want to open the account and make a deposit as soon as you can to start the 5-year clock. There are certain exceptions if you are under 59 and a half years of age and the account is at least 5 years old, such as if you become disabled. If you're a first-time home buyer and you can withdraw up to $10,000, or if you die, your beneficiary can make withdrawals. Otherwise, you may be subject to taxes and/or penalties. We won't go into the details of this, and again, if you do intend to fund a Roth IRA, it would be best to start the 5-year clock sooner rather than later because you never know what will happen. We'll get into withdrawing contributions in another slide, but we do want to note that it would be a good idea to play it safe and track your contributions so that you don't exceed them if you do have to make a withdrawal. So why would you want to utilize a Roth IRA? Let's go over the pros first. Similar to other retirement accounts, the earnings are tax-free. So if you receive a dividend or realize a gain from, say, selling a stock, there would generally be no taxes. I say generally because foreign taxes on dividends may apply. For example, if you hold the ticker VALE, then you'll be hit with a foreign tax during each dividend distribution. I know this because I was used to hold VALE and was taxed each time I got a dividend distribution. Roth IRAs also generally have a large selection of investments to choose from. You can generally hold any security such as stocks, bonds, and funds. We see this as an advantage over the 401k because you're not limited to proprietary funds and target date funds. If you wanted to have a concentration of, say, semiconductor stocks, you could buy into a fund such as SMH, which is focused on semiconductors. With the recent approval of spot Bitcoin ETFs, you're also able to indirectly hold Bitcoin in a Roth IRA as well. You generally won't be able to invest in these ways in a 401k account. You won't, however, be able to hold certain investments such as collectibles and property in a Roth IRA. Another pro for the Roth IRA is that the contributions can be withdrawn without penalty. This allows some flexibility in how the Roth IRA can be used. For example, you could treat a part of your Roth IRA as an emergency fund. If you contributed $10,000 over time, you could withdraw that same amount without taxes and penalties. We don't like to do this though because it means you're liquidating holdings because you usually don't hold too much cash in a retirement account. We prefer to have a separate emergency fund, but if times really get tough, a Roth IRA could be an additional source of funds if absolutely needed. There are also no required minimum distributions, or RMDs, so you could allow the account to continue to grow indefinitely. This can be an advantage if you want to use your Roth IRA as an inheritance, where your heirs or heir would inherit the account and not have to pay taxes. There are rules, though, for when they would have to take distributions, and we're not going to go into that because it's more related to estate planning. I'd encourage you to look into it more, though. So what are some cons of the Roth IRA? Unlike a traditional IRA, your contributions are not deductible for filing taxes. So the contributions are post-tax dollars, and you'll pay more taxes now. If you watched our video on 401k accounts, we explained how this could be a disadvantage if you expect to be in a lower tax bracket during retirement. Distributions of earnings are only qualified under certain circumstances. And as we discussed earlier, you can expect to pay taxes and penalties if the earnings are withdrawn as non-qualified distributions. We don't see this as much of a concern, though, because we try to stay away from withdrawing from retirement accounts. And if we had to withdraw from our Roth IRA, there should be a significant cushion of contributions before earnings are withdrawn. Another con of the Roth IRA, and with any retirement account really, is that realized losses cannot be deducted when you file taxes. You can't have it both ways, so be especially careful when investing in retirement accounts. We'll make a video later on that goes over the kind of investments that we choose to make in each of our accounts. Finally, Roth IRAs may not be attractive if you expect to be in a lower tax bracket during retirement. One of the situations we cover later on in the video will illustrate this. So let's go through some hypothetical situations. We'll be going over 3 different situations. Situation 1 is Jen, who is early in her career and in a lower tax bracket. She expects to be in a higher tax bracket during retirement. And situation 2 is Sam, who is in the middle of his career and is expecting to be in the same tax bracket in retirement as he is right now. Finally, we have Adam, who is in the later stage of his career and expects to be in a lower tax bracket during retirement. These situations are a bit simplified because we're trying to show how the traditional and Roth IRA may work out for each person. We assume that there is no change in their contribution, and we're also going to assume that the marginal tax rate will be applied to these accounts to simplify things. We're not going to account for state income taxes because every state is different. Putting some numbers to the name, Jen is 25 years of age and currently in the 22% marginal tax bracket. She is planning to retire at 65 years of age and in the 24% marginal tax bracket. She has $4,500 of pre-tax money available to contribute each year. And as usual, we'll assume a 7% compounded annual growth rate. We explain in our 401k video why we use this assumption, but in short, it is discounted from the long-term compounded annual growth rate for the S&P 500. As a result, the higher tax rate during retirement provides Jen with a higher net return if she contributes to a Roth IRA by about 3%. This doesn't seem like much because of the small difference between her current and expected marginal tax rates of only 2%. We should note, though, that this is a snapshot of her projected balances and the tax liability at that time. Since she would not likely liquidate her entire account when she turns 65, the taxes owed in the traditional scenario would vary from what is shown and will be spread out as she makes withdrawals. We're presenting the snapshot because it is a simple way to view it, and the withdrawals over the course of retirement may be too variable. Running through the numbers, with the traditional IRA, she contributes $4,500 each year. However, with the Roth IRA, since contributions are made with post-tax dollars, she is able to contribute $3,510 each year. Her balance at 65 years of age is a little over $960,000 for the traditional IRA and about $750,000 for the Roth IRA. The snapshot taxes owed on the traditional IRA amount to just over $230,000. On the Roth IRA, there are no taxes owed going forward, and Jen has paid just under $40,000 in taxes on the money used for her contributions throughout the years. This results in a net of around $730,500 in the traditional IRA and about $750,000 in the Roth IRA. The takeaway here is that you can't come out ahead by utilizing a Roth IRA earlier in one's career due to the taxes being paid at a lower rate. This would be especially true if Jen was in, say, the 12% marginal tax rate, or if the government decides to introduce a new marginal tax bracket between the existing 24% and 32% ones, and Jen happens to fall into that during retirement. Now let's go over situation 2, with Sam, who is 45 years of age and in the 24% marginal tax bracket. He's expecting to retire at 65 years of age in the same marginal tax bracket as present. Sam has $6,000 in pre-tax money available to contribute each year. And once again, we'll assume a 7% compounded annual growth rate. In Sam's case, there wouldn't be a difference in the snapshot at the time of retirement. With the traditional IRA, he is able to contribute $6,000 each year. However, with the Roth IRA, he is able to contribute $4,560 each year. His balance at 65 years of age is around $263,000 for the traditional IRA, and just over $200,000 for the Roth IRA. The snapshot taxes owed on the traditional IRA amount to just over $63,000. On the Roth IRA, Sam has paid just under $29,000 in taxes. This results in a net of around $200,000 in the traditional IRA and the Roth IRA. The takeaway here is that if you expect to be in the same marginal tax bracket in retirement as when you are making contributions, it may not make a difference in whether you go with a traditional or a Roth IRA. However, one or the other may have a slight advantage depending on the rate of distributions taken or if there are other aspects to each account that may be desired. Now let's see what the numbers look like for Adam, who is currently 55 years of age and in the 24% marginal tax bracket. Adam is expecting to retire at 65 years of age in the 22% marginal tax bracket. He has $8,000 of pre-tax funds available to contribute each year, and again we'll assume a 7% compounded annual rate of return. Adam will net more in a traditional IRA than a Roth IRA. It isn't a whole lot more because there is only a 2% difference in his marginal tax bracket, but similar to Jen, the difference would be greater if Adam ended up falling in the 12% marginal tax bracket during retirement, or if the government decided to establish a new tax bracket that falls between the 12 and 22% current marginal tax brackets. Going through the numbers, he is able to contribute $8,000 to a traditional IRA and $6,080 to a Roth IRA. His balance at 65 years of age is around $118,000 for the traditional IRA and just under $90,000 for the Roth IRA. The snapshot taxes owed on the traditional IRA amount to just over $26,000. On the Roth IRA, Adam has paid just over $19,000 in taxes. This results in a net of just over $92,000 in the traditional IRA and just under $90,000 for the Roth IRA. The takeaway here is that if you expect to be in a lower marginal tax bracket in retirement, then it may make sense to contribute to a traditional IRA instead. There are a few things to consider when deciding on an IRA. As we always say, the highest priority we have here at the Commonwealth for retirement accounts is to maximize our employer match in our 401k. After that, there are a few considerations, such as if you are starting to make contributions early on or later on in your career. Because while this isn't always the case, a lot of people expect to be in a lower tax bracket while they are early in their careers compared to retirement. And so it may be better to contribute to a Roth IRA until the expectation changes, say, later in one's career. Another consideration is if a diversification in tax liabilities and advantages are desired. You could have a mix of a traditional 401k and a Roth IRA. Another thing to consider is how a health savings account may play into your overall savings and retirement goals. We'll go over those in a different video. A mixture of income sources in retirement may also be advantageous. For example, if you have a traditional 401k and a Roth IRA, you could make withdrawals from the 401k until you reach the next marginal tax bracket for the year, and then you'd start withdrawing from your Roth IRA to reduce your total taxes paid. Finally, are you planning to leave your retirement funds as an inheritance? The tax implications for your heirs would differ depending on the type of account that the inheritance is coming from. Our approach at the Commonwealth is largely influenced by the flexibility a Roth IRA provides. We prefer to have some flexibility because you never know what life throws at you. When it comes to the Roth IRA, we work towards maxing out our contributions if we can. This is after maxing out our employer match for a 401k account. We are investing in funds that we're planning to hold until retirement. These are largely indexed funds, such as for the S&P 500 and international stocks. We also hold our real estate investment trust shares in a Roth IRA for tax reasons. We'll make another video going over why this is the case and the kinds of securities we hold in each of our accounts. The flexibility for contributions is something that we find attractive. And we are expecting to be in about the same tax bracket in retirement as now, but want to have some tax diversification because there are too many unknowns at the moment. Since the traditional 401k account has RMDs and we are wanting to keep some funds invested in a tax-advantaged account, the Roth IRA helps solve this because there are no RMDs applicable. This is also beneficial because we plan to leave it as an inheritance. We see the Roth IRA as a good inheritance vehicle because of its tax advantages. That's all we have in this video for the Roth IRA. If you found the information to be helpful, please hit the like button and subscribe. We'll be making more videos, and if there's anything you'd like us to cover, or if you have any questions about this video, please feel free to leave it as a comment.